Hi there. In this business topic video, we're going to take a look at the concept of shares, the shareholdings in the company, and also look at what we mean by share prices and how those translate into the value of a business, which is known as the market capitalization. Now, of course, the starting point for understanding shares is to understand what do we mean by a company. A company, or as it's often called, an incorporated business, is a separate legal entity. It has its own legal personality, and the owners of the company are what is known as shareholders. They hold shares in the company, shareholders. There are two main types of company. There are private companies where the shares are held privately. The important point about private limited companies, as they're usually called, is that they are by some distance the most common type of incorporated business. Millions of private limited companies in the UK alone. Often they have just one, sometimes two or three shareholders, but they can have many more. And importantly, they're very quick and very easy to set up. They're private, there's a minimum of administration required, very easy to set up and very easy to administer. Importantly, with private limited companies, the shares in those businesses cannot be sold using a public stock exchange. That's not to say that shares in private companies can't be bought and sold, because of course they can, but not on a public stock exchange. The other type of incorporated business is what's known as the PLC, or Public Limited Company. And these are typically much larger businesses. There is a requirement for them to have a larger share capital, a minimum of £50,000 in the UK. And often they have a much wider shareholder base, many more shareholders, and usually the shareholders aren't involved in the day-to-day running of the business. The shares in a public company can be traded on a public stock market. It's not a requirement that they are, but all shares that you see on the London Stock Exchange or the US NASDAQ stock exchange, those are all public companies. Let's just think about what do we mean by a share. If a shareholder is somebody who has a share in a business, what do we mean by a share? Well, the share capital of the company is divided into shares. It's the equity or the capital that's invested into the business as a source of finance. And each one of those shares has some important rights. Typically, an ordinary share has a voting right, one vote per share normally, related to the shareholding. And also shareholders have the right to receive dividends if the board and if the company approve the payment of a dividend to the shareholders. So essentially the shareholders are the owners of the company, and they manage that ownership of the company by appointing a board of directors if they need to, if they're not involved in the day-to-day operation of the business. But ultimately the ownership and the big decisions of a company are determined by the shareholders. Here's just a little simple example of what do we mean by a shareholding, just to show how a share capital can be divided up into a number of different people, and their shareholding is expressed as a percentage of the total number of shares in issue. Let's have a look at the data here. This company has 20,000 shares of £1 each, and we've got 5 people there have subscribed for those 20,000 shares, but they've subscribed for different numbers of shares. So Ollie, the first one there, has 3,000 of the 2,000 shares. If you express that as a percentage, that's 15%, whereas Jim appears to be the majority shareholder. He has more than 50% of the shareholding because he owns 11,000 of the 20,000 shares. Now, as a shareholder, you are looking to gain a reward from your shareholding, and there are two types of reward for being a shareholder. Firstly, as we've already mentioned, you may be paid a dividend, which is a payment to you per share from the reserves or profits of the business. And secondly, you will hope that the value of your shareholding will rise over time as the value of the business grows over time. That's what's known as capital growth, sometimes known as a capital gain, if you're able to sell the shares for more than you paid for them. Let's have a quick look at those two sources of rewards for being a shareholder. Dividends, as we've mentioned, are payments made to shareholders out of the reserves of the earned profits of the company. If the business does not earn profits, if it does not have reserves of profits from previous years that it's able to distribute, it's not allowed to pay a dividend. And of course, it doesn't have to pay a dividend if it doesn't wish to. If it wishes to retain the profits in the business as a key source of finance rather than paying a dividend, then depending on who makes the decision in the company, it's perfectly allowed to do so. But a dividend is paid per share. So for example, if you've got a share, the dividend may be £1 per share in a particular year. Capital growth or capital gains is a slightly different thing. And the issue here really is, what price did you pay for your shares? Because it's only when you compare the price you paid for them and the price you end up selling your shares for that you can decide whether or not there has been any capital growth in the value of your shareholding. So a capital gain or capital growth arises when the business as a whole increases in value, and that should be reflected in an increase in the share price. But of course, you only gain a capital gain if you sell your shares for more than you paid for them. And as we know from shareholding, particularly on stock markets, the price of shares can fall as well as rise. So it's perfectly possible for you to make a capital loss where the value of your shares falls compared with what you paid for them. Investing in shares is a risky business. There's no guarantee that you will make capital gains. Which brings us on, therefore, to mention of a share price. What do we mean by the share price? Well, it's the price of a share, and like all prices in all markets, it's determined by demand and by supply. So if more people want to buy a share of a company than are willing to sell it, in theory the price of that share will rise. Conversely, if lots of people are trying to sell shares in a company but relatively few want to buy them, you should see the share price fall in value. And of course, as we know from looking at stock markets around the world, share prices are constantly moving by the second up and down based on that interaction between the demand for shares from buyers and the supply of shares from people wanting to sell their shareholdings. Now, of course, we've mentioned already that there are two different types of company, and therefore there are two different share prices to consider here. For a private company, the share price isn't publicly quoted, and it only really gets determined when someone wants to either buy or sell a share, and a market has to be created in order for that to happen. So when you first buy your shares, there's the price, but when you come to sell it, there won't be a market price for it. You'll have to negotiate that selling price and try to assess what is the fair value for you as well as for the buyer. By contrast, a public company whose shares are listed on a stock market, it's really easy to work out what the share price is because the market is telling you second by second. It's displayed in real time whilst the market is open. And in fact, there are even markets predicting what the share price is going to be when the markets are closed. So you can always find out what the share price of a quoted public company is. Very widely published. And as we'll see in a second, a very important information because it gives you information about the market value or the market capitalization of the company. So a share is a part of an ownership of a company, and a share price is determined by the demand and supply for those shares. Here's a quick illustration of how share prices can move, and this is a great example of a company whose share price has grown and grown over the last 8 to 9 years. It's Apple. The chart illustrates, or the top part of the chart illustrates the daily share price at the closing rate on the New York stock market of one Apple share. And we can see it's grown from, let's have a look, halfway through 2008 it was about sort of $10 a share, and now latest data somewhere around about $120, $130 per share. So if you're a shareholder buying the shares back in 2008, your shareholding will be worth around about 10 to 15 times now what you paid for it. That is what's known as capital growth. Of course, there are a whole bunch of different factors that affect a share price, particularly the share price of a quoted company. Let's just briefly look at those for a couple of minutes so you've got a few ideas on factors that affect the share price. There are some things that are actually within the company's control. So the board of directors wanting to raise the share price and increase the value of the company, it will have some influence over some of these factors. For example, it could decide to pay a higher dividend, which may attract more buyers of the shares and therefore raise the share price. It could consistently and accurately communicate with all the key investors in the market, giving them sensible views on the growth prospects and the likely profits of the business. And that's often a factor that leads to a share price being rated as being a high quality stock to buy. And of course, most importantly, it's within your control the financial performance of the business. The profits that you make, the cash flows that you generate, the strategic decisions that you take, the quality of your team, the quality of your business is entirely within your control, or 99% within your control. And therefore, you might argue that a business gets the share price it deserves. However, of course, the board will argue that there are always going to be factors outside of the company's control, that actually you may be doing all the right things in terms of the strategy and the management team and the way the business is run, but actually there are other factors that are depressing the share price, which hopefully will be short-term factors. For example, it could just be that the stock market itself is going through a period of poor market sentiment, not a lot of enthusiasm for buying shares. The economy could be going through a significant dip, perhaps entering a recession or a downturn, which is likely to reduce the returns of many of the companies on the stock market. And of course, it could well be there are some better alternatives out there, maybe some more exciting businesses with better growth prospects, and therefore investors start to invest in their shares and sell your shares to turn your shares into cash to invest in alternatives. So at any one stage, share prices move up and down, factors within the company's control, and a lot of the time it's outside of the company's control. One thing to look out for is what's known as a profits warning. You'll see these increasingly in the news. What happens is that in the market, investors have an expectation of what the likely profits of the business are going to be when they next get reported, because the stock market tends to look forward, to look at the future prospects of a company. Therefore, the share price to a large extent reflects the expectations of the business's prospects. How fast is it likely to grow? What kind of profits should the market expect the next time the financial results come out? If the market has expectations that are too high, the board is under a responsibility for a quoted company to let the market know that the expectations are too high. It's what's known as a profits warning. They warn that profits are likely to be significantly lower than market expectations. And nearly always, profits warnings are seen as bad news. You'll see a share price dip substantially. Of course, as a board, you need to avoid profits warnings, and in particular, avoid giving more than one of them in any sensible period of time, because you soon get a reputation for being a business that is not communicating properly with the market. Now, one last thing to have a look at, it's a concept called market capitalization, sometimes shortened to the phrase market cap. So market cap means the same thing as market capitalization. And what this means is it's the value of the business as represented by the share price at any one point in time, multiplied by the number of shares in issue in the market. So the simple calculation for market capitalization is the latest share price multiplied by the number of shares in the market. And that is an excellent proxy or representation, if you like, of the value of a quoted company. Very widely used, a market cap valuation. And what I've just done on the slide here is to illustrate some different market capitalizations of 4 fairly well-known businesses, just so you can get a sense for how market capitalization can vary. So, for example, Apple, which is one of the world's most profitable companies and also one of the world's most valuable companies, currently, as I speak, has a market capitalization of $612 billion. And that is calculated by multiplying its current share price, which, as I look at the screens, is $110.44. Almost certainly that would have gone up or down a little bit in the next few minutes. Multiplied by the number of Apple shares in the market. Those are the supply of shares, which is just over 5.5 billion shares. And if you work the numbers, that's how you can value Apple with a market cap of £612.6 billion. Compare that, say, with, let's pick another one. Let's pick Tesco's, the one down. Has more shares in issue, but the point about Tesco is that it doesn't generate anywhere near the same profits as Apple. The share price is substantially lower per share. And as a consequence of multiplying 8.73 billion shares by the share price of £1.83, the current market capitalisation of Tesco's is just under £16 billion, £15.9 billion. And of course, you can see from that as the share price changes day by day, hour by hour, minute by minute, the market capitalisation of the business will also move up and down. Guys, I hope that's been helpful. This has been just an introduction to what we mean by shares, shareholding, and we've also had a brief look at the factors that influence whether share prices move up and down, and how share price is linked to the value of a business, which is called market capitalisation.